Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So we've got the YUK here, and I'm going to, just for convenience, I'm going to be using my little charting application here that I tend to favor for this kind of thing, and it's tied into a paper trading application that I think is pretty good, so that I can illustrate, well, what do the chain sheets look like, what does pricing on these options look like, and how might we approach constructing a trade depending on what we're looking at. Now, what I'm going to be talking about, though, is more kind of strategically oriented than necessarily this is what I would do today. It's more a matter of trying to illustrate, okay, this is how I would approach, this is how I might apply a strategy to what's going on right now. And I wanted to start with YUK for a couple of reasons. Number one, YUK, it's for those of you out there, and I can already see from several of the attendees. I'm looking at some of your names. I recognize you from Learning Markets, so welcome. But so you're probably currency traders, and I wanted to just talk a little bit about how currencies are priced versus the currency options. So currencies are traded in pairs, so it's kind of like when you see a currency quote, what you're seeing is, well, how many of X currency does it take to buy a dollar? So in this case, what we're seeing with YUK is that it's telling us that we need to spend 96.73 yen to buy a dollar. So that's how many yen to the dollar right now. And if we assume that the dollar is going to get stronger, then we would anticipate that it's going to cost more yen in the future. So we're going to be up here in the 106 range, let's say, in a few months, if the dollar continues to get stronger. Or if the dollar gets weaker, it's going to cost us fewer yen to buy this. And this is exactly how currency pairs work in the spot market as well. One of the differences, however, and the reason why I started here with YUK is because it's real similar to, it looks, the way that it's priced is very similar to how it's priced in the spot market when you're trading Forex spot currencies. But the options here are a little bit different in that every penny change over here, so every second, we go out to the second decimal place, every little change there is worth, you times it by 100, and so it's worth about $1. So if you were to ignore time value and all these kinds of things, if the market goes up, that's worth about $1 of intrinsic value if you're in the money, and you lose about $1 intrinsic value if you're in the money if it goes down. So if you're a spot trader, which I know many of you are, one way to look at this is that these option contracts are roughly the equivalent of a mini contract in the spot FX. Now, for those of you who don't trade the spot, a mini contract is essentially a futures contract, or it's very similar to a futures contract, and it represents 10,000 units of the base currency, or in this case, that would be the dollar. So if you were trying to look at, well, what does this compare to? It's roughly a mini contract, because a pip change in the spot market is going to be worth about $1 with a mini contract, and it's the same thing here. So it's a decent way to try to make these relate to each other from the spot market to options. Now, when I started out my presentation saying we're going to talk about limited risk, or, if you will, limiting risk. And I mentioned that I have some insight into what do retail traders look like, active retail traders look like in the options market and in the Forex market. And there is an issue that we deal with in those two markets, and that is that retail traders tend to they don't have as long a lifespan on average. Their accounts don't have as long a lifespan as we would love them to have. One thing that we know is that there is a direct correlation with investors who are educated and longer lifespans, so those who are actively getting education. And probably the common denominator that we can find there as to what education made the biggest difference, it's money management. So I know there's a bunch of you out there that are probably nodding your heads at this point going, oh yeah, of course, if you survive in the market for very long, you learn that's largely what it's all about. And so I think that, options are a whole nother tool to be able to put in your arsenal to limit that risk and to provide a little bit of money management. And I have a couple of examples here. So what I'd like to do, I'm going to shift off of the YUK, which is the dollar yen. So this is, we're looking at the yen. And I'm going to switch to the SFC. So SFC, this is the symbol for the franc. So this is the dollar franc. And once again, because the dollar, in the spot market, the dollar is on the same side of this equation, of this numerator-denominator problem, as it is here with the options. So this chart is going to look very similar to if you brought up just a spot chart of the dollar franc. So if you're looking at a spot chart, this is going to look really similar with one difference. You'll notice over here on the right-hand side that the decimal has been moved over to the right 2 places. So for those of you who are options traders and not spot traders would be looking at this quote as 1.1603. So meaning that it takes 1.1603 francs to buy $1. So the franc is worth a little bit less than the dollar, and the higher this goes, the stronger the dollar is getting because it costs more francs to buy the dollar. Now, what a spot trader would do and approach this problem is that right now we've been, I think this is a really relevant discussion because, the pattern over the last few months has been that every time the market gets a little bit confident, the banks leak out a little bit more bad news, right, or unintentionally or intentionally, whatever it is, and traders start to cover, and the exuberance kind of wears out. So we have much more downside risk right now than we've had upside risk. Well, interestingly, while that may be bad for equities, it's actually pretty good for the dollar. And so as long as we have this uncertainty just piled up in the banking industry, which, today was encouraging, certainly, but certainly wasn't a game changer. So as long as we have that uncertainty kind of piled up in the banking sector and the credit market in general, and we have these runs going at banks here internationally, and we have this tightness where the Federal Reserve is having to actually send dollars out to other central banks to keep their liquidity open in their lending facilities. So as long as that's the situation, which it is right now, we tend to have kind of a bullish dollar bias. Well, what that means is we're looking for opportunities to the upside here on the franc. Now, these are recommendations. I'm just using as an example as to how might I approach the problem. The issue is, of course, that while this may be good for the dollar because, the dollar is a nice store of value internationally, when there's a lot of uncertainty, traders start to move into the dollar or cash equivalents like treasury bonds and these kinds of things, which is very supportive to the dollar, increases demand for the dollar as they exit things like equities or wherever else they're invested. Well, all these things are really supportive for the dollar, but it's kind of one of these, any trend that's based on fear and uncertainty tends to be, inherently a little fragile. Well, this creates risk. So what happens is we get these really big corrections. And now, while this may be problematic for Forex traders who are just trading the Forex itself, which we know is problematic because, account values have been dropping on average very much faster the last few months than it has, on average or over the long term. So we know that Forex traders are having problems. Well, I think one of the ways we can solve this problem is by looking at, well, how can we enhance our risk control by using Forex options? There's two, so I'll give you a couple of examples. So let's say, for example, that we were long the Swiss franc in the Forex. Okay, so we're betting on a stronger dollar against the franc, or in a way that's kind of the equivalent of saying that we're long the dollar against even the euro and such. And however, we know that there's some risk to the downside. We could approach this by limiting that risk with a Forex option trade. So from the ICE, SFC has an options chain sheet attached to it that looks just like a chain sheet from a traditional stock, so Google or whatever. I'm going to switch gears here. I'm going to actually pull up a chain sheet for SFC.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.